$500,000. That is how much the federal system protects per account if your brokerage firm collapses. Most investors have no idea that number exists, but here is what almost nobody tells you about it. That protection does not do what most people assume it does. And the risk it leaves completely uncovered is the one that actually shows up in your account every single decade. If you are 30 to 55 with a brokerage account at Fidelity, Vanguard, or Schwab, and you have quietly wondered whether your money disappears if one of those giants goes under, this is not a paranoia problem. It is a definitions problem. You're conflating two risks that the financial system treats as entirely separate categories. Once you see the distinction, the anxiety changes shape. It does not disappear, it just moves to the right address. And the math behind where that risk actually lives is more interesting than most financial content will ever tell you. Let's start with the fear, because the fear is understandable. Fidelity manages over $10 trillion in customer assets. Vanguard manages roughly $8 trillion. These are numbers so large they stop feeling real. And somewhere in the back of the financially literate brain, a question forms. If a bank with a few $100 billion can fail, what happens to a firm holding 10 times that? If the whole structure wobbles, does my account go with it? The answer starts with a legal wall you probably did not know was there. Every registered broker-dealer in the United States operates under SEC Rule 15C3-3, known as the Customer Protection Rule. It has been federal law since 1972. The rule does one thing with unusual clarity. It prohibits broker-dealers from using customer assets to finance their own business. Your stocks, your bonds, your index funds are not sitting in a general pool that Fidelity can dip into to cover its own obligations. They are held separately at third-party depository institutions, specifically for you, the Depository Trust Company, Bank of New York. Institutions whose entire function is custody. This is what I call custody separation. And it is the foundational reason why broker failure is a categorically different event from bank failure. When a bank fails, the bank's assets and your deposits exist on the same balance sheet. The bank lent your money out. It invested it. If those bets go wrong, your money is part of the wreckage. That is why FDIC insurance exists. That is why bank runs happen. With a brokerage, the legal structure explicitly prevents that scenario. Your Apple shares are yours. Fidelity cannot pledge them as collateral. Fidelity cannot use them to cover a margin call on its own trading book. If Fidelity files for bankruptcy tomorrow, a trustee shows up, finds your shares exactly where they are supposed to be, and the process of returning them begins. The actual historical record on this is instructive. SIPC, the Securities Investor Protection Corporation, has overseen 330 brokerage failures since it was created by Congress in 1970. In 99% of eligible cases, investors got everything back. When MF Global collapsed in 2011, one of the largest bankruptcies in American history, customers received 100% of their assets. When MJK Clearing Corporation failed in 2001 due to outright fraud, SIPC advanced $177 million and returned assets to 175,000 customers in approximately 1 week. 100 cents on the dollar plus interest. The system, when it functions for its intended purpose, functions well. Consider what that track record implies. There have been roughly 40,000 broker-dealer members since SIPC's founding. 330 failures over 5 decades is less than 1% of all firms that have ever operated, and no case since 2017. The fear of brokerage collapse is not irrational, but the probability attached to it, at least for the largest registered firms, is genuinely low. That does not mean the risk is zero. It means the risk is being priced correctly when you see it assigned to the bottom of the protection stack, under custody separation, under SIPC, under excess coverage. This is the channel where we put numbers in their correct context. If you want to keep getting this kind of breakdown, hit subscribe. One of these every week. But none of that means your account is invincible. And this is where we need to slow down because the misunderstanding runs in both directions. Most investors either overfear the broker failure scenario or they hear the reassuring data about custody separation and assume they are protected from everything. Neither posture is correct. There is a second layer to understand, and it matters. This is the coverage layers. The system does not just rely on custody separation. It adds 2 additional rings of protection specifically for the scenario where assets go missing even after segregation. Maybe there was fraud. Maybe there was a record-keeping failure. SIPC exists precisely for that gap. Here's how the coverage stacks. The base layer is SIPC itself. Every registered broker-dealer in the United States is required to be a SIPC member. If a firm fails and customer assets are missing, SIPC steps in and covers up to $500,000 per customer, including a $250,000 limit for uninvested cash. It is worth being precise about what that $500,000 means. It is not the limit on how much you can hold at a brokerage. It is the limit on how much the insurance will make up if assets are actually missing. If you have $800,000 in a standard brokerage account at Fidelity and the firm collapses, the first $500,000 in missing assets is covered by SIPC. Anything above that would depend on what is recovered from the estate plus the next layer. And there is a next layer. The major firms have gone well beyond the SIPC baseline. Fidelity carries what is called excess SIPC coverage through Lloyd's of London. The aggregate total is $1 billion. Within that policy, there is no per-customer dollar limit on securities coverage. If your Fidelity account holds $3 million in stocks and bonds, the securities portion of that coverage extends to you without a ceiling. There is a per-customer limit of $1.9 million on uninvested cash sitting in the account. Schwab carries $600 million in aggregate excess SIPC coverage with a per-customer limit of $150 million. Vanguard maintains additional coverage beyond the SIPC baseline as well, though the firm does not publish the specific aggregate figure. Picture those layers on a bar. The base of the bar is custody separation, which means the assets were never supposed to be at risk in the first place. On top of that sits SIPC, covering up to $500,000 for the scenario where something is actually missing. On top of that sits the excess coverage, running into the hundreds of millions per customer at the largest firms. The bar is tall. For most individual investors, it is taller than the value of their entire account. Now here's the twist. And this is the part that the reassuring content usually skips, because it requires honesty about what protection actually means. Neither SIPC nor XSIPC covers market losses. Not $1. The language in every policy document from every firm is identical. Protection applies to the failure of the brokerage and the loss of assets. It does not apply to investment losses in customer accounts due to market fluctuation. This is the distinction that actually matters for your financial life, and it is worth sitting with for a moment. If Fidelity went under tomorrow due to fraud or insolvency and your account showed $400,000, the coverage system described above would work to return that $400,000 to you. That is the broker failure scenario. The coverage layers address that risk. If the risk is real, the protection is real, and the historical track record is genuinely strong. But if the S&P 500 drops 40% next year and your $400,000 account becomes $240,000, not a single dollar of that $160,000 loss is covered by anything. That is the market risk scenario. It was never covered. It will never be covered, and that is correct and appropriate because market risk is the price you pay for market returns. You are not supposed to be insulated from it. The two risks are categorically different, and the system treats them that way deliberately. The natural reaction here is to say, okay, but I already knew the market could go down. What I was worried about was Fidelity specifically, and that concern is valid. It deserves a real answer, not a dismissal. So let me give you the strongest version of the worry and then tell you what the data actually shows. The concern goes like this. These firms are enormous. They are systemically important. If one of them ran into real trouble, the scale could overwhelm the protection layers. SIPC has about $1 billion in reserves. Fidelity manages 10 trillion. Is the safety net actually large enough for the scenario people are imagining? This is a legitimate structural question. Here's the honest answer. The protection layers are designed for operational failure, not for systemic collapse of market value. If Fidelity went bankrupt due to mismanagement or fraud, the assets in your account still exist as your assets. They are not part of Fidelity's bankruptcy estate. The trustee locates them, verifies them, and transfers them. SIPC steps in for any gap. The $1 billion SIPC reserve and Fidelity's $1 billion excess coverage are not trying to replace $10 trillion of market value. They are covering the potential gap between what should be in accounts and what is actually there. Historically, that gap, when it has existed at all, has been a small fraction of total assets. No brokerage the scale of Fidelity or Vanguard has ever failed. No SIPC proceeding has ever come close to exhausting the fund in a single case. These are facts worth holding alongside the concern. The stillman for worry is this. If you are operating in a scenario of complete systemic financial collapse, a scenario in which Fidelity, Vanguard, and the entire regulatory infrastructure fail simultaneously, you are in a world where the coverage layers are the least of your problems. Treasury bonds, money market funds, and cash at FDIC-insured banks are all downstream of that same collapse. The question of whether your brokerage is safe in that scenario is inseparable from the question of whether any financial institution is safe. And the answer to that question is the same for every instrument in every account. Most investors who worry about Fidelity collapsing are not actually worried about systemic civilizational failure. They are worried about the more bounded scenario, the Lehman scale event. And for that scenario, the custody separation plus coverage layer structure has handled every actual case on record. So where does that leave you operationally? 3 things worth doing. Step 1 is know your SIPC capacity. If you hold an IRA and a standard brokerage account at the same firm, those are separate capacities under SIPC rules. Each is covered up to $500,000 independently. 2 traditional IRAs of the same firm are treated as one capacity and share a single limit. If your account values are pushing above the thresholds that make you think about this, knowing exactly how your accounts are structured matters. Log in, look at your account types, and check whether your structure maximizes your separate coverage. Step 2 is understand what the coverage does not touch. Write this down somewhere, you will see it. SIPC and excess SIPC protect against broker failure and missing assets. They do not protect against the market falling. If you are worried about your portfolio losing 30 or 40% of its value in a downturn, the right tool is asset allocation, not checking the size of your excess SIPC policy. Those are answers to different questions. Step 3 applies if you hold very large positions above the SIPC threshold in uninvested cash specifically. Excess SIPC coverage at Fidelity caps cash at $1.9 million per customer. At Schwab, the combined per customer limit is $150 million. If your uninvested cash exceeds those figures, understanding how to structure that across institutions or account types is worth a conversation with a fiduciary advisor. Here's the reframe that I think actually changes how you carry this. The anxiety most investors feel about their brokerage account is real, but it is aimed at the wrong address. Custody separation means your assets were never Fidelity's to lose. The coverage layers mean that if something goes wrong with the record keeping or the transfer, you have a system built specifically to make you whole. The historical record of that system, 99% recovery across 330 cases over 5 decades, is not a marketing claim. It is a track record. The risk that is genuinely uninsured is market risk. And that risk sits in your account whether your broker is Fidelity, Vanguard, Schwab, or a firm that has never heard of excess SIPC coverage. The market going down is not a brokerage problem. It is an investment problem, and investment problems have investment solutions, which is a different conversation entirely. There is something clarifying about pointing your worry at the right target. It is not that the fear goes away, it is that the fear becomes useful. You stop checking the financial health of Fidelity, and you start thinking about your allocation, your timeline, and whether the risk you are carrying is the risk you actually intended to take. That is the only kind of worry that earns its keep. Drop a comment with the question you've actually been sitting on about account protection. The ones that feel too basic to ask out loud are usually the most important ones. And if you are in that 35 to 55 window trying to make sure the structure of your accounts actually makes sense, hit subscribe. This is Salary to Strategy. We publish one of these every day. I will see you in the next one.